Hi everyone! Welcome to our channel where we simplify complex topics into easy-to-understand explanations. Today we're diving into general life insurance policy provisions. Whether you're studying for your insurance license or just want to understand your policy better, this video is for you. Let's get started. What are general life insurance policy provisions? Most states require life insurance policies to include a standard set of provisions. These provisions outline the duties, obligations, and rights of both the policyholder and the insurer. They're designed to protect the policy owner and ensure clarity in the contract. 1. Entire contract provision. The entire contract provision states that the policy, along with the application and any attached riders or endorsements, makes up the entire agreement between the policyholder and the insurer. Example: if the insurer tries to deny a claim by saying they didn't provide the full contract, this provision prevents that. Key point: no outside documents can be referenced, and no changes can be made to the policy after it's issued without mutual agreement. 2. Execution clause. The execution clause states that the contract is valid once both parties, the insurer and the policyholder, fulfill their responsibilities. Example: the policyholder pays the premium and the insurer agrees to provide coverage. 3. Modification provision. This provision requires that any changes to the policy must be in writing and attached to the policy. Only authorized company officers can make modifications. Example: adding a rider or changing the face amount of an adjustable life policy. 4. Privilege of change clause. This clause allows the policyholder to change the policy's coverage under specific conditions. Example: switching from a whole life policy to a term life policy without proving insurability if the premium increases but the face value stays the same. 5. Insuring clause. The insuring clause is the insurer's promise to pay the death benefit to the beneficiary upon the insured's death. Example: a policy might state, "We promise to pay $100,000 to the beneficiary if the insured dies." 6. Consideration clause. This clause states that the policyholder must pay premiums in exchange for the insurer's promise to pay benefits. Example: if the policyholder's check bounces, the contract is void because there's no valid consideration. 7. Incontestable clause. After a policy has been in force for 2 years, the insurer cannot contest its validity, even if there was fraud in the application. Exceptions: impersonation, lack of insurable interest, or intent to murder. 8. Misstatement of age or sex provision. If the insured's age or sex is misstated, the insurer will adjust the death benefit to reflect the correct information. Example: if the insured's age was understated, the death benefit will be reduced proportionally. 9. Suicide clause. If the insured commits suicide within 2 years of policy issuance, the insurer will not pay the death benefit but will refund the premiums paid. Example: if John commits suicide 6 months after purchasing the policy, his beneficiary will receive a refund of premiums paid. 10. Owner's provision. Rights of policy ownership. This provision outlines the rights of the policy owner, such as naming beneficiaries, borrowing against cash value, and selecting premium payment schedules. Example: a parent can own a policy for their child and transfer ownership when the child turns 21. 11. Assignment provision. This provision allows the policyholder to transfer ownership rights to another person or entity. Types: absolute assignment, full transfer of ownership. Collateral assignment, partial transfer often used to secure a loan. 12. Free look provision. This provision allows the policyholder to review the policy for a specified period, usually 10-30 days, and return it for a full refund if unsatisfied. Example: if the policyholder receives the policy on January 25th, they have until February 4th to return it for a refund. 13. Grace period provision. If a premium payment is missed, the policy remains in force for a grace period, usually 30 days. Example: if the insured dies during the grace period, the beneficiary receives the death benefit minus the unpaid premium. 14. Reinstatement provision. If a policy lapses, the policyholder can reinstate it within a specified period, usually 3 to 5 years. by paying back premiums and proving insurability. Example: if a policy lapses due to non-payment, the policyholder can reinstate it by paying all past due premiums. 15. Non-forfeiture options. If a policyholder stops paying premiums, they can choose one of 3 non-forfeiture options. Cash surrender option. Receive the policy's cash value. Reduced paid-up option. Stop paying premiums and reduce the death benefit. Extended term option. Use the cash value to purchase term insurance. 16. Policy loan provision. This provision allows the policyholder to borrow against the policy's cash value. Example: if the policyholder needs cash, they can take a loan against the policy's cash value. 17. Automatic premium loan provision. If a premium payment is missed, the insurer will automatically take a loan from the policy's cash value to cover the premium. Example: if the policyholder forgets to pay the premium, the insurer will use the cash value to keep the policy in force. 18. Beneficiary designation provisions. The policyholder can name or change the beneficiary at any time unless the beneficiary is irrevocable. Example: a policyholder can name their spouse as the beneficiary and later change it to their child. 19. Settlement options provision. This provision outlines how the death benefit can be paid to the beneficiary, such as lump sum or installments. Example: the beneficiary can choose to receive the death benefit in monthly payments instead of a lump sum. 20. Accelerated death benefits. Rider. This rider allows the insured to access a portion of the death benefit if diagnosed with a terminal illness. Example: if the insured is terminally ill, they can receive up to 75% of the death benefit while still alive. 21. Waiver of premium rider. If the insured becomes disabled, this rider waives premium payments while keeping the policy in force. Example: if the insured is disabled for 6 months, the insurer will pay the premiums until they recover. 22. Accidental death benefit rider. This rider pays an additional death benefit if the insured dies in an accident. Example: if the insured dies in a car accident, the beneficiary receives double the death benefit. 23. Guaranteed insurability rider. This rider allows the policyholder to purchase additional coverage at specific intervals without proving insurability. Example: the policyholder can buy more coverage after getting married or having a child. 24. Cost of living. Rider. This rider increases the death benefit based on inflation. Example: if inflation rises by 2%, the death benefit increases by 2%. 25. Payer rider. If the policyholder is paying for a child's policy and dies or becomes disabled, this rider waives future premiums. Example: if a parent dies, the child's policy remains in force without further premium payments. 26. Term insurance riders. These riders add temporary coverage to a permanent policy. Example: a 10-year term rider can be added to a whole life policy for additional coverage. 27. Exclusions. Policies may exclude certain causes of death, such as suicide, war, or illegal activities. Example: if the insured dies while committing a felony, the insurer may deny the claim. And there you have it, a comprehensive breakdown of general life insurance policy provisions. If you found this video helpful, don't forget to like, subscribe, and hit the bell icon for more insurance tips. Thanks for watching, and I'll see you in the next video.